Have you ever wondered how to reduce risk in your investments? Well, there's a word for that in the world of finance, and it's called diversification. Diversification, in the simplest terms, is a strategy that mixes a variety of investments within a portfolio. The rationale behind this technique contends that a portfolio of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Think of it as not putting all your eggs in one basket, but rather spreading them out across multiple baskets. This way, if one basket falls, not all your eggs will be broken. Diversification is one of the crucial techniques that allow investors to manage their risk and potentially increase their profits. So, the question arises, what exactly is diversification in investments? Let's dive deeper. In simple terms, diversification is like not putting all your eggs in one basket. It's a principle that allows you to spread your investments across various assets to mitigate risk. Imagine your investment portfolio as a pie. Rather than having one big slice, you'd want your pie to be cut into several different pieces, each representing a different type of investment. Let's delve into some examples. Stocks, for instance, are shares in companies. They can offer high returns but also come with high risks. Bonds, on the other hand, are more like IOUs from governments or corporations. They promise to pay back your investment with interest over a certain period. Bonds are generally considered safer than stocks but offer lower returns. Real estate investments involve purchasing properties for rental income or capital appreciation. These can provide a steady income stream and potential tax benefits. Precious metals like gold and silver are often used as a hedge against inflation or economic downturns, providing a safety net in volatile markets. And then we have the new kid on the block, cryptocurrency. Digital currencies like Bitcoin and Ethereum have seen astronomical rises in value, but they are also highly volatile and can be risky. So, how does diversification tie into all this? Well, by spreading your investments across these different assets, you're essentially creating a safety net. If one investment performs poorly, it won't drag down your entire portfolio. Instead, losses in one area could potentially be offset by gains in another. This strategy not only reduces your overall risk, but also increases your potential for profits. For instance, if you'd invested all your money in tech stocks in the late 90s, you would have lost a substantial portion of your investment when the dot-com bubble burst. But if you diversified and included some bonds or real estate in your portfolio, your losses would have been cushioned. Diversification, therefore, spreads the risk and increases the chance of profits. It's like a balanced diet for your finances. A mix of different investments can help ensure a healthier, more stable financial future. Now that we have a basic understanding of diversification, how does it work in real life? Let's consider a few examples of real investors' portfolios. Imagine investor A, who has all his investments in technology stocks. If the tech industry takes a hit, his portfolio could potentially plummet. Now consider investor B, who has her investments spread across technology stocks, government bonds, real estate, and gold. If the tech industry faces a downturn, her portfolio takes a lesser hit, as her other investments could remain stable or even appreciate. This is the power of diversification. It's like a safety net that cushions the blow when one investment doesn't perform as expected. But remember, while diversification can reduce risk, it doesn't eliminate it entirely. Now let's look at some diversification strategies. One popular approach is the asset allocation strategy. In this method, you spread your investments across different asset classes such as stocks, bonds, real estate, and commodities. Each asset class responds differently to market conditions, providing a balance in your portfolio. Another strategy is the sector diversification strategy. This involves spreading your investments across different sectors like technology, healthcare, finance, or utilities. Each sector has its own growth potential and risks, making it another way to achieve a balanced portfolio. Finally, there's geographical diversification. This strategy involves spreading your investments across different countries or regions. It's a great way to tap into the growth potential of emerging markets and hedge against regional economic downturns. These strategies are not mutually exclusive. In fact, combining them can create a highly diversified portfolio that's resilient to market volatility. However, keep in mind that diversification is not a one-size-fits-all strategy. It should be tailored to your financial goals, risk tolerance, and investment horizon. The right diversification strategy can significantly reduce your investment risk. You might wonder, why is diversification so important? Well, it's a fair question, and the answer is this. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this approach is that a portfolio of diverse investments will, on average, yield higher returns and pose a lower risk than any single investment found within the portfolio. Consider this. If you put your entire life savings into a single company's stock and that company goes bankrupt, you lose everything. But if you spread your investments across a variety of different companies and industries, the success or failure of one company won't dramatically affect your overall portfolio. For instance, let's take the case of two investors. Investor A put all their money in technology stocks, while Investor B diversified their portfolio with a mix of stocks, bonds, real estate, and precious metals. Back in the dot-com bubble burst of the early 2000s, Investor A would have seen their portfolio value plummet, while Investor B, thanks to the diversified nature of their portfolio, would have been better insulated from this market downturn. It's not just about protecting your downside either. Diversification can also enhance your potential for growth. Different asset classes can perform well at different times. For example, when stocks are down, bonds might be up and vice versa. By having a mix of both, you're more likely to have a portion of your portfolio performing well, regardless of market conditions. In the world of investing, there's no such thing as a sure bet. Every investment carries some degree of risk, but diversification allows you to spread that risk around so you're less likely to lose everything if one investment goes south. As we can see, diversification plays a crucial role in determining the success or failure of an investment portfolio. It's a fundamental principle of investing, and understanding it is key to managing your risk and maximizing your potential returns. So remember, don't put all your eggs in one basket, spread them out, and give yourself the best chance of success. To simplify the concept of diversification, think of it as a basket of eggs. Imagine you have a dozen eggs. You could put all of them in one basket. But what if you stumble? What if the basket tips over or the handle breaks? That's it. All your eggs are gone, broken on the ground. This, in essence, is the risk you take when you put all your investments into one asset class or one type of investment. But let's rethink our egg handling strategy. What if instead of one basket, you had several? You could put some eggs in one basket, some in another, and so on. Now, if one basket tips over, you'd lose some eggs, sure. But you wouldn't lose all of them. The eggs in the other baskets would still be safe. That's diversification. Diversification in investment works the same way. It's about spreading your investments across different asset classes, be it stocks, bonds, real estate, precious metals, or even cryptocurrency. By doing so, you're not putting all your financial eggs in one basket, so if one asset class doesn't perform well, the others might still do fine. Say, if the stock market crashes, your bonds and real estate could still hold their value or even increase. This spreading out helps to balance the risk and potential rewards across your investment portfolio. Of course, it's not a guarantee against loss, no investment strategy is, but it's a way to manage and mitigate risk. And in the world of investing, managing risk is key. To sum it up, diversification is about not putting all your eggs in one basket. It's about spreading the risk, balancing potential rewards, and ultimately, it's about being smart with your money. Because at the end of the day, it's not just about making money. It's about preserving and growing what you have in a sustainable way. Just like with eggs, it's wise to spread your investments across different asset classes. Diversification, therefore, is a key strategy in achieving your financial goals. It's like a safety net, catching you when some of your investments fall while others rise. It's not a magic spell that wards off all loss, but it's a smart move to manage risk and potentially yield better returns. Imagine you're on a ship in the middle of the ocean. Diversification is your lifeboat. It won't prevent a storm, but it will keep you afloat when the waves get rough. It's all about spreading your investments across various assets like stocks, bonds, real estate, precious metals, and even cryptocurrency. Remember, diversification isn't about chasing the next big thing. It's about providing a balance, a safety net, a buffer against the unpredictable market. It's about playing the long game in the financial field. Start diversifying your investments today, and remember, don't put all your eggs in one basket. If you found this video helpful, subscribe to our channel and leave your comments below.